Do you know why two people can earn the same income, invest in similar markets, and still end up in completely different financial places decades later? It is rarely about intelligence. It is rarely about secret strategies. It is almost always about habits. In this video, we shall share the top 5 investment habits that compound over decades. These are not flashy moves. They do not promise fast money. They do not depend on perfect timing or constant market watching. They are simple behaviors repeated year after year, quiet habits that look small in the beginning but grow powerful with time. Let's begin. 1. Investing regularly, not occasionally. This is a foundation that everything else rests on. Most people wait for the right time to invest. A bonus, a raise, a market dip, a feeling of confidence. The problem is that waiting creates gaps, and gaps break compounding. Investors who build wealth over decades treat investing like a monthly responsibility, not a decision they keep revisiting. Money goes in whether markets feel good or bad, whether headlines are positive or negative, whether motivation is high or low. Regular investing does 3 important things. First, it removes emotion from timing. You are not trying to guess when to buy. You are spreading your entry points across many moments in time. Second, it builds momentum. Even small amounts add up when contributions never stop. What feels insignificant in year 1 becomes meaningful in year 10. Third, it turns investing into a habit, not a struggle. Once something becomes routine, it requires less willpower. This habit matters because most wealth is built from income earned gradually, not from large one-time windfalls. People who invest regularly stop waiting for perfect conditions and start letting time do the heavy lifting. Consistency beats intensity when the goal spans decades. 2. Diversify instead of investing everything on one idea. Many beginners believe focus means putting all their money into their best idea. One stock, one sector, one asset class. It feels confident and decisive. It feels like commitment. But in investing, this kind of focus often increases risk instead of reducing it. Long-term investors think differently because they respect uncertainty. They know that no matter how strong an idea looks today, the future can change it quickly. Technology shifts. Regulations change. Consumer behavior moves on. Even great companies face bad decades. Diversification is not about trying to win big in the best possible scenario. It is about surviving when things do not go as planned. It accepts a simple truth. You do not need to predict the single best winner if you avoid the single worst failure. Markets move in cycles. Entire industries fall out of favor for years. Countries go through slow growth periods. Companies that once dominated can shrink or disappear. No investor can consistently know which asset will lead every decade. By spreading investments across different asset sectors and sometimes regions, damage stays limited. When one area struggles, another may remain stable or grow. This balance protects capital and gives recovery time to work. This habit compounds quietly because it keeps people invested. Large losses often trigger panic selling. Diversification reduces those extreme swings. Smaller drawdowns feel manageable. Investors stay calm. They stay patient. They stay in the market. Diversification also protects behavior. When your future is not tied to one idea, emotions soften. Decisions become clearer. You stop defending bad positions out of pride. Wealth grows best when risk is spread thoughtfully, not concentrated boldly. 3. Aligning investments with personality and risk tolerance. The best investors know themselves, and this habit matters more than most strategies people talk about. It often gets ignored because it sounds abstract or psychological, but in practice it affects every decision you make. People react very differently to risk. Some can watch markets swing without stress. Others feel tension the moment prices drop. Some enjoy tracking numbers and making adjustments. Others prefer simple systems that run quietly in the background. None of these traits are good or bad. Problems start when personality and strategy do not match. When investments feel uncomfortable, emotions take over. Anxiety builds during downturns. Headlines feel louder. Small losses feel dangerous. That is when panic selling happens. That is also when people abandon plans at the worst possible time, locking in losses and missing recoveries. Long-term investors choose strategies they can live with. They think about how much volatility they can tolerate, how long their money can stay invested, and how involved they want to be. This might mean accepting slower growth for peace of mind. It might mean automating contributions, so emotions stay out of the process. It might mean holding fewer assets, so decisions stay clear. The goal is not to copy what works for someone else. A strategy that fits one person can be unbearable for another. The goal is to build a plan that feels steady during calm markets and stressful ones. This habit compounds because it reduces self-sabotage. A strategy only works if you follow it. The smartest plan on paper fails if emotions break it. Knowing yourself turns discipline into something natural, not forced, and that consistency is what allows wealth to grow over decades. 4. Thinking long-term and ignoring short-term noise. Markets are loud by design. News updates never stop. Prices flash constantly. Opinions change by the hour. Predictions conflict daily. This constant noise creates pressure to react, even when action is unnecessary. Long-term investors learn to tune most of it out. They understand a simple truth. Time in the market matters more than timing the market. Short-term movements feel urgent, but they rarely define long-term outcomes. Over decades, results come from staying invested, not from jumping in and out based on emotion or headlines. This habit requires patience, especially early on. The first years of investing often feel slow. Progress looks small. Accounts grow gradually. Doubt shows up because effort does not seem rewarded yet. Many people quit during this stage because they expect visible results too quickly. Compounding does not work in a straight line. It builds quietly at first. The early years lay the foundation. Capital accumulates. Contributions stack. Then later, growth accelerates. The visible gains people admire usually come after long periods of consistency. Investors who think long-term do not judge success by weeks or months. They do not even judge it by a single year. They measure progress in decades. Their focus stays on goals like retirement, financial independence, or long-term security. Short-term fluctuations become background noise, not signals. This mindset helps them stay calm during downturns. They expect volatility and plan for it. It also keeps them grounded during strong markets. They do not chase excess risk when things feel easy. Ignoring short-term noise is not ignoring reality. It is choosing discipline over distraction. It is deciding that not every piece of information deserves action. This habit protects decisions, preserves consistency, and allows time to do the heavy lifting that no shortcut can replace. 5. Automating and simplifying wherever possible. Automating and simplifying investing is a habit that makes all the others sustainable. Without it, even the best intentions break down over time. Many people believe investing demands constant attention. They check prices daily. They react to headlines. They adjust positions frequently. This feels responsible, but often creates stress and unnecessary mistakes. Constant monitoring does not increase control. It increases emotion. Long-term investors take a different approach. They design systems that run in the background. Contributions move automatically from income to investments. Allocations follow a clear structure. Rebalancing happens on a set schedule, not in response to fear or excitement. This habit protects consistency. When investing is automated, it continues even when life becomes busy, energy drops, or markets feel uncomfortable. You do not need motivation every month. The system does the work for you. Simplification also reduces decision fatigue. Each extra choice creates friction. Each extra decision invites second guessing. By using fewer strategies and clear rules, investors lower the risk of emotional interference. Fewer moving parts mean fewer chances to panic, chase, or overcorrect. Automation does not mean neglect. It means intention. Long-term investors still review progress. They check alignment with goals. They make adjustments when life circumstances change. The key difference is timing. Decisions are planned, calm, and deliberate. Over decades, simple systems outperform complex ones for one reason. They get followed. Consistency beats complexity when the goal is long-term growth. When investing becomes routine instead of reactive, compounding finally gets the space it needs to work. Now, let's connect these habits. Regular investing creates momentum. Diversification manages risk. Self-awareness prevents emotional mistakes. Long-term thinking keeps you invested. Automation protects consistency. None of these habits are exciting. That is why most people ignore them. But together, they create a powerful compounding effect, not just on money, but on behavior. Wealth is not built by one smart decision. It is built by thousands of small, sensible decisions repeated over time. You do not need to master everything today. You only need to start building one habit and protect it. If this video helped you see investing differently, like it. Share it with someone who keeps waiting for the perfect moment to start. Subscribe to the channel for more clear, practical insights on building long-term wealth. Thanks for watching.